The biggest story in markets right now, it's not about stocks hitting fresh records or bonds finding new lows. It's about trust. Trust in the jobs data. Trust in the Fed's next move. Trust in whether the market can keep running on hopes of rate cuts. We just seen record options activity, collapsing treasury yields, and a labor market revision that could completely rewrite the story of 2025's economy. Today we'll break it all down. We'll get current together. I guess comment for more, everybody. So today there was a lot of green in the markets, a lot of fluctuations though, with the Dow closing up 0.25%, S&P 500 rose 0.21%, NASDAQ gained 0.45%, Bitcoin up 1.21%. You see that bottom chart right there, that bottom right one? That's TLT, that tracks longer term bonds. That one has came completely out of the grave and reached almost as high as 90 on the day. The lift came on optimism around the Fed's September 17th meeting that's right around the corner, where rate cuts are now fully priced in. And traders are pretty happy about that. They're now piling into these bullish bets. So on Friday, we seen more than 5 million S&P 500 contracts, options contracts traded, which was the second highest volume on record. Options activity shows investors are showing a lot of interest in rushing towards these smaller cap and economically sensitive stocks, with many of them focusing on call options, or the right, not the obligation, to purchase a share at a specific price. You usually do that when you feel like the price of the stock will be higher at some point in time. It's usually just seen as a bullish sign. So they're positioning for upside even as this labor market is kind of weakening. So as CBOE's Mandy Zhu put it, investors are choosing to focus on the positives of the Fed easing rather than a weakening jobs picture. But on the bond markets front, it's telling a completely different story, because treasury investors have gone aggressively bullish, driving the 10-year treasury yield down to 4.04%, its lowest intraday level since April. That's a 22 basis point drop in just 4 sessions, and that's its sharpest fall since spring. And treasury yields and treasuries have this inverse relationship. So usually when treasuries, like, nobody wants them, the price goes down. Think about like when a stock goes down. And then like there's other assets out there that these treasuries are competing with, like stocks, for example, like Tesla. Well, when these treasuries are going down and nobody wants them, the way that they entice people, like, hey, look at me, come buy some of this over here. They offer this yield. And when the yield's high, it's usually because the treasury price is low. So when people are buying them up, there's a ton of demand. And this is supply and demand 101. When they drive up the price, think like stocks like AMC and GameStop. When the price goes up because a ton of people want them, the yield goes down because they don't have to pay this premium to get people interested. So when the yields fall this hard, this fast, it's usually a signal of this growing concern about the economic outlook. The question now is the Fed cutting because of it's their choice to do so, or by necessity? Are they cutting because the economy is just completely resilient, it's just a good time out there? Or is it because it's getting a little tight out there? So if it's by choice, if you're part of that camp, easing to keep growth intact, equities cheer, it's a good time out there, the party continues. But if it's by necessity, if it's because they have to, cutting because the economy is already sliding, then rate cuts won't feel like a victory. It's like you're partying and somebody turned the lights off and the music off, and then like everybody's like, hey, who did that? So they'll feel like confirmation of trouble in that case. And the data is stacking up against the labor market. So today the BLS, the Bureau of Labor Statistics, will release its revision. Well, that's tomorrow. So on Tuesday, they'll release their revisions on to their employment numbers for the past year. Goldman Sachs estimates that job growth may have been overstated by as much as 80,000 per month. 80,000 per month. But that means that the labor market we thought was holding up pretty steady may actually have been much weaker than anybody was guessing. And confidence is already sliding, so a New York Fed survey shows that Americans' perceived chance of finding a new job if they lost theirs just fell to 44.9%, which was the lowest since records began back in 2013. And economists say that job hugging or staying in place out of the fear of uncertainty is spreading across many different industries in the economy. The Conference Board's Employment Trends Index fell again in August, now at its lowest level since early 2021. And all of this just adds to the backdrop of the Labor Department report last week showing that the U.S. added only 22,000 jobs in August, the weakest print in years. And they were expecting it to come around like 70,000, 75,000 jobs. We only got 22,000. So without healthcare jobs, payrolls might have even gone negative. So now the September 17th meeting with the Fed is fully priced in. It's a 100% chance of a rate cut. But between that, it's where do we really fall? It's about an 89% chance of a quarter point rate cut, or almost about 11% chance of a 0.5% off the Fed funds rate. But history says that investors should be cautious. Since 1980, the stock market has actually fallen in 40% of cases 1 month after the Fed rate cut. That's because the reason why the rate cut is why the cuts were cut. That's a funny way to say it. But behind the cut matters more than the cut itself. So it goes back to what we were just talking about. Are they cutting because of choice or necessity? What's the purpose behind it? So like I said, if the Fed is cutting into strength, markets usually rally. But if they're cutting into weakness, stocks often stumble. So we got some time to watch out for that. This week will be a pivotal point. Tomorrow we'll get those BLS revisions, then CPI, PPI this week, sentiment surveys later on this week, and all of it will build towards the September 17th meeting. I'm sure that CME Fed Watch tool we just had up, those numbers and percentages will keep on fluctuating and changing. And when Powell and the Fed will decide whether they're cutting rates or are proactively or reactively. We'll just find out. But the main takeaways here, markets are optimistic, bonds are cautious, and the labor market is flashing red. So which one's right? We're about to find out, everybody. Stay tuned. We'll keep on tracking everything going on. I'll be here tomorrow to talk about the news that's news. And everybody, I hope your weekend was phenomenal. Hope your day is great, and master the week, everybody.